I think the absolute key takeaway for us is to say there are some astonishingly attractively priced assets. We're going to look back and say that this was a once in a generational opportunity to kind of be long risk assets. This is the time to kind of be courageous and to hold on to your risk assets. Selling them now into cash, that will be permanent capital destruction in our view.
Afternoon, everybody. Thank you for joining us at another Prudential podcast. I'm Christo Geier, Head of Business Development, and chatting this afternoon to my colleague David Nee, our Chief Investment Officer, trying to make some sense of the market moves of the last few weeks. David, gosh, what a month.
What a month indeed.
Did you ever think in your investing career following the global financial crisis that you would be experiencing these conditions?
Look, I'm older than I look, and my career's kind of spanned a long time. I saw, the crash of the Japanese stock market and the dot-com bust, and then, obviously the GFC. But I think what's been astonishing about this is just the unexpected nature and the rapidity with which kind of events have unfolded, with some of the most rapid market price action and increases in volatility since, the Great Depression in the 1930s.
It's obviously a major event for investors and in fact for Homo sapiens. It may have some positive spin-offs for Mother Earth, time will tell. Just as an investor, how do you think about the opportunities? How do you think about responding to the incoming deluge of information?
Sure. I mean, look, we live in a world now where kind of information overwhelms us on a daily basis, and asset managers are never going to be experts in the spread of a virus and what effect that's going to have. So our process at Prudential is one where we seek to kind of exploit I think the fear which inevitably arises in these kind of events, and you see that whether that's kind of in panic buying of toilet rolls or it's in panic selling of stocks and bonds, and so we try and be as tough as it sounds, kind of as unemotional as we can about what's being presented to us in terms of market prices. But clearly it's not easy. Nobody knows how long this is going to continue. The global economy feels like it's coming to a full stop. There are real kind of hard issues that are going to come and hit companies. Anyone that's got debt and still has expenses to pay, clearly you've got some potentially major problems there if your balance sheet is currently stretched. So that does lead us into thinking about what sort of companies you might want to be exposed to. But in terms of I think how we proceed from here, Prudential's applying its valuation process that actually has kind of worked through all of those crises that I talked about before. It is worth kind of bearing in mind, even if we cast our minds back to the 1987 kind of market crash in developed markets where, the S&P fell 20% on one day, that actually over the calendar year 1987 markets were up. So, it feels disastrous and we can't see our way through it, but we think that we're being presented with a once-in-a-generational opportunity to buy some incredibly cheap assets.
David, zooming in on the SA market, of course, which is the bulk of our South African clients' portfolios, the narrative seems to be that globally that was really a liquidity issues that have driven a lot of the perhaps even automated short selling, etc. Were similar factors at play in the SA market, in your view?
Look, I mean, South Africa is unusual in an emerging market context in that we have essentially a kind of developed market structure for our financial market, and probably the most liquid emerging market in the world, and so it is natural that I think where investors do find themselves wanting to reduce risk appetite, that they come to places where they can actually find liquidity. When we see that in other asset classes as well, it has been a very peculiar last couple of weeks, I guess, in global markets, in that, for instance, we've seen US bond yields rising rapidly. In any other circumstance, one would have always said, US bond yields are a safe haven asset, and in this kind of environment, they would be falling like a stone. And you can't say, well, why is that? Why have they been going up? And obviously, we don't know for sure, But I think one possible answer to that is that you have seen this kind of leveraged plays having to unwind, and people seeking liquidity. US Treasury market, probably the most liquid asset in the world after cash. And similarly, some of that has probably fed through into markets like South Africa. But you've also seen, to be fair, some very kind of sharp price action in other emerging markets too, which don't offer our kind of liquidity. So it does appear that there's this kind of generalized risk off, and that's led to some, in our view, some kind of valuation opportunities that we probably haven't seen in South Africa since the apartheid years.
From a price to book perspective, the South African market appeared cheaper than global markets prior to all of these events. So certainly there didn't appear to be any buffer, any margin of safety.
Well, in terms of the market move, it's certainly true that the valuation difference between the South African market and global markets hasn't helped you. So as this kind of unfolded, South African equities were trading roughly on a 1.5 times price to book. So the price of the equity is relative to the book value of the company's assets. The global markets were trading on a price to book of closer to 2.5. So that did look like a very big gap relative to history. And in an ordinary kind of regular cyclical downturn, we would have expected that valuation buffer to protect the returns of the South African market, because the low price to book already suggested that there was a lot of kind of bad macroeconomic news priced into South African equities that wasn't in global equities. But what we've actually seen is that South African markets fallen just as much as global markets have, and such that we're now looking at a price to book on our market of around 1, which is probably 20% below where we got to in the global financial crisis. And we know what happened after that. Our market then went up 30% a year compound for 5 years. So the prospective returns from here look incredibly enticing. The uncertainty about how long it will last, how big an effect it'll have on companies, who will be the survivors and who will be the losers. We can see those stresses in the South African market and in global markets. One can look at the US high yield market as a kind of bellwether of companies and sectors. All the usual suspects under massive pressure: hotels, energy, airlines. If people aren't traveling, if they're not flying, if they're not renting cars, then you obviously are going to see a kind of full stop coming in those companies' earnings. And the question then is it going to be a 6-week stop, or is it going to be a 6-month stop? And some companies may not survive. But that said, the US in particular has already announced a whole raft of measures that are going to be designed to support a lot of those industries that are most hard hit. Maybe the fact that Trump owns some hotels himself might incline him to do something to help the hotel industry. But no, seriously, they, whether that's initially giving some debt for kind of forbearance, or ultimately injecting equity into some of these companies, as we saw in the GFC, into banks. South Africa's not there yet in terms of announcing those measures, but it does feel like, we had the Reserve Bank announcing its rate cut, the government departments coming and saying they're going to start deploying some cash for small and medium-sized enterprises. But, I think we're just kind of running a little bit behind the global schedule because coronavirus came here later. So, but I think it's not unreasonable to suspect that, our kind of playbook is going to follow what we've seen elsewhere, but with a little bit of a lag.
It certainly does seem like a buyer's market, the South Africa in particular. You and your investment team colleagues, how are you guys currently thinking about, guys and girls currently thinking about specific asset classes?
Yeah, everywhere you look, obviously, assets look cheap. If you start with what we would regard as a safe haven asset, South African government bonds, you can lend money now to the South African government for 20 years at a nominal yield of 12%. You know, inflation just printed this week at 4.6. So, you know, you're looking at a, you know, real yield there prospectively of close to 8%. You know, that's an extraordinary prospective return. Inflation-linked bonds, government bonds that are explicitly linked to inflation, offering you a real yield of 5%, guaranteed 5% real yield, which again, you haven't seen since probably 2001 in those assets. You know, and then if you look into equity, we've touched on kind of the market, the price to book of 1. You know, you look across stocks, there are many stocks within the market that are now trading on low single-digit PE multiples, which again, you can say these are kind of decent companies that, yes, are exposed to the South African macroeconomic story, but you know, if you can potentially, I mean, we look at that asset and kind of say, you know, why is it trading on a PE of 3? You know, there surely must be some value there. Now, obviously, on stock selection, I mean, my colleague Ross Biggs, in one of the other podcasts that you'll be able to watch, has talked much more about equities, and clearly one does need to be careful to make sure that you're identifying the companies that are genuinely going to be able to survive, and that does at the moment necessitate kind of stronger balance sheets. And I think that's the you know, the work that equity teams and analysts kind of are doing, and that we're doing here at Prudential to ensure that you know, that those companies that have been derated but still have decent balance sheets and long-term business, kind of good business prospects, are represented in our portfolio as overweight positions.
I don't know the triple for Annus Horribilis, but the property sector's woes continue.
Sure.
Yeah. Comments?
No, look, I mean, again, I think there, the key is going to be stock selection. There will be some property companies that are not going to make the cut, and you know, they may even find themselves in a situation, you know, now that they won't be absorbed by another company. You know, Growthpoint is not going to necessarily come to the rescue of some of the smaller players that are trading on what appear to be very attractive yields. You know, I mean, in some cases, high yields are simply telling you that the market doesn't believe the earnings are going to be coming through. You know, there are huge challenges in the retail industry, you know, from, you know, a quarantine, isolation framework. And unfortunately, you know, the narrative there was already very challenging, given South Africa's had the best part of a decade of slowing macroeconomic growth. So we'd seen SA retailers, particularly those that are kind of in general retail and fashion, taking massive pressure on margins, and looking for landlords to bear some of their pain. And that story is just going to be exacerbated by you know, the coronavirus episode. Yeah, so within property, stock selection's definitely going to be key. Again, we've been focusing on, you know, the stronger players and avoiding those where we have kind of genuine concerns. You know, some of those companies, I mean, Redefine as an example, you know, on our calculations, that stock's current leverage is over 50% of loan to kind of value of its assets. You know, and those asset values may well fall in this kind of environment, and that could cause some very significant stress. So, you know, that would be a stock where I think we would have some concerns. You know, and it is also, as an asset class, I think the uncertainties about the fundamental outlook for property have been a reason why, from an asset allocation perspective, we've been underweight property. And as property as an asset class has fallen in this year, we haven't kind of continued to add. We've let that property weight shrink in the portfolio, and been preferring to add equity and bonds, where we see a greater likelihood of achieving superior returns going forward.
David, are there any particular portfolio changes that are beginning to, you know, be discussed amongst the team? In particular, again, I guess specific buying opportunities that are percolating to the top?
Look, our process is one where, as assets become cheaper, we will want to lean into that valuation, and it has worked very well over long periods of time, but clearly patience is critical in that. So, as equities have fallen, we've been keen to add to equities incrementally, and that's also been true in adding to nominal bonds as those yields have suddenly kicked up. In some cases, we've seen yields rise by, 200, 250 basis points to levels that
once in a career.
No, absolutely. To levels that hadn't been seen, since the early, the early noughties.
Twice in a career.
Yeah, at turn of this decade. But obviously, bear in mind then, back in 2001, inflation was 8%. Inflation's now 4%, and you're being offered the same nominal yield. So, the prospective real yield is far higher now. So, we've been incrementally adding to that. We've deployed, some further cash that, where portfolios had liquidity available, particularly into bonds. As I say, we've kind of allowed the property part of the portfolio to shrink a little bit, given our uncertainties about the earnings outlook for the sector as a whole.
The offshore portion of our multi-asset portfolios are managed by our colleagues at M&G Investments. Any idea what sort of areas are looking attractive to them?
Yeah, I mean, actually, if we kind of circle back a little bit and just talk about South Africa versus offshore, I think to reiterate comments by some of my colleagues, the rand does look very cheap, probably, certainly as cheap as it was in the Nenegate situation, and bear in mind, the returns post Nenegate in South African assets were fabulous, as the rand appreciated. So, we at an asset allocation level, we have been looking to bring, some of our exposure in offshore assets, which has obviously been increasing as the rand has done poorly and the South African assets have also performed poorly. We've brought some of that back into South Africa, and been happy to kind of deploy that as I intimated earlier into equities and bonds. Within the global part of the portfolio, I think the recent price action, is inclining them to look at developed market equity as an attractive option there. Previously, we had been focusing on perhaps some of the higher yielding emerging markets where, given the developed markets, particularly the S&P, had looked expensive. So we'd been happy to kind of be underweight the US equity market into some select emerging. And I think what's changed is that, some of those developed markets, maybe particularly the European markets, have been looking, I think after this market move, to offer really, I think, attractive long-term value. The S&P looks to us, to be fair, it's had a huge derating. You've gone from a 19 forward PE to a 14, but it doesn't look really cheap, whereas some of those markets now are pretty much as cheap as they were in the global financial crisis.
Thank you very much, David. Fascinating insight as always. We hope that our viewers enjoyed that, and we look forward to continuing the conversation in the coming weeks.